Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest quarterly report from StratCap Digital Infrastructure REIT. This is going to be interesting because, let's face it, digital infrastructure can sound like a snooze fest, but trust me, these reports always have a story to tell. We'll see if StratCap is building an empire or just a really expensive phone stand. So what's the scoop? StratCap Digital Infrastructure REIT, they actually changed their name from Strategic Wireless Infrastructure Fund 2. So keep that in mind if you are a long-term investor. They focus on owning things like data centers, cell towers, and fiber networks, things that make the internet run. The report covers their performance through March of this year. Let's get right to the important stuff and make sure to join our Discord linked in the description. A lot of other people that are also investing and want to learn are there. All right, let's take a look at the condensed balance sheets. This is where we see what the company owns and owes. One of the biggest changes is that cash and cash equivalents increased to about $423.40 Nolans. That can mean a lot of things, but the total assets increased overall to $123, down to $340. Total assets increased overall to $123.40 more liquid assets. However, investments in the Datacom joint venture decreased a bit, down to $38.7 million things, but the total assets increased overall to 123 times $4 million. That can mean a lot of things, but the total assets increased overall to $123.40 increased overall to $123.47 million. That can mean a lot of things, but the total assets increased overall to $123.04 million. That can mean a com joint venture decreased a bit, down to $38.7 million. That can mean a lot of things, but the total assets increased overall. Now let's flip over to liabilities. That loan payable jumped up to almost $35 million. An increased loan balance could mean expansion, but it also means more debt to manage. Now, for the bad news, the total shareholders' equity decreased a decent chunk to $63.3 million, as shareholders' equity represents ownership and value for investors. This decrease is never optimal. All right, let's decode the income statement. Rental revenues, which are their bread and butter, increased to just over $1 million for the quarter. However, their total expenses were over double that at $2 million. It's always a bad sign when revenue doesn't cover expenses. And there it is, a net loss of nearly $3 million. Ouch. Basic and diluted loss per share landed at negative 25 cents. This means each share lost a quarter of its value. That compares to negative 20 cents a year ago, which means the company is going in the wrong direction. Next up, we can analyze the changes in equity. We see common stock activity through share issuances, but importantly, the accumulated deficit continues to increase, which means the company continues to lose money and deplete its funds. Moving to cash flows, the company does not make money from their daily activities, again as seen here, as indicated by this negative $955.20 net loss. Their main income driver is in fact issuing more stock. Hopefully that changes soon. So what do they actually do? Well, StratCap is trying to get into the digital infrastructure game. They focus on data centers, cell towers, fiber networks, the backbone of our connected world. They operate as a REIT, which is a real estate investment trust. That means they're supposed to generate income from real estate investments and pass most of it back to shareholders. They are externally managed, meaning they hire another company to run the day-to-day stuff. They were focused on an initial public offering. They also did a name change in October. So if you hold shares for longer, you need to keep that in mind when you see the name StratCap Fund 2 Inc. in older paperwork. Now, they had an offering where they registered a bunch of shares. Selling new stock is their income. So let's take a look at more interesting stuff. Let's dive into this public offering that I mentioned. They've registered shares, but they're doing it with a twist, a multi-class structure offering Class T, Class S, Class D, and Class I shares. The offering price changes from month to month depending on their NAV plus fees, which means even StratCap can't promise what it will cost for a new investor to invest. Checking the company expenses in more detail, lease obligations that also include power and insurance have been a notable expense that took a decent chunk of the company's fund. Looking at the asset side, most of its assets include cell towers and land, which is a good sign. This means that the company owns the locations that generate them most of their income. They also have some intangible assets, including contract rights for tenants and capacity. It's important to understand that the assets depend on their customers. Without customers, their assets would be useless. Digging through the liabilities, they've got a pretty significant loan payable. That's debt they need to manage. They have entered into a credit agreement and has used it multiple times. They also have to maintain certain financial ratios, such as the amount of months data centers are used, and keep total debt under a certain percentage of the total asset value. So that is something the company has to keep in mind. Something very interesting is that as of the report date, all the legal obligations related to infrastructure were already performed, so there are no extra asset obligations. And then we get to the equity section. This is where the different share classes come into play. They've got classes AAIX, IIX, IIX, AIX, and a few others. Each class has different rights and fees, which makes it a bit complex. But what is important is that all of them will share in distributions. Now let's see what management has to say. The following discussion should be read in conjunction with the consolidated financial statements. We get a big bold warning about forward-looking statements. If they say things such as plan, continue, intend, may, and estimate, it should be taken with a grain of salt, because these predictions are not guarantees. Now for the bad news. Our board will at all times have ultimate oversight and policy-making authority. But we are also aware of material trends that may affect the value of the income we derive. Our future depends on the tenants' economic environment in the markets of our properties and the ability to sell assets. Interestingly, it looks like the manager has been supporting the business. The advisor may provide the support in the form of deferral of the collection of its management fees or through actual expense support payments. This basically means that the manager can defer expenses if needed, which may lead people to believe that the report is more successful than it actually is because some costs may not be taken into consideration.